Just checking the scoreboard today. Dow down 626, NASDAQ down 577. Welcome to September, bitch. That's the vibe. That's the vibe today. The summer is over, and here we are. Hey, everybody. Welcome to a new edition of What Are Your Thoughts? My name is Downtown Josh Brown, here with my co-host, as always, Mr. Michael Batnick. Michael, say hello.
Hello, folks.
See, I can make him do that. It's like a ventriloquist almost.
Wild.
Yeah. Michael is wearing the appropriate head covering today for the high holidays, which will also take place in September. Who else do we have in the chat today? Jeff Asola is here. Cliff and Drew and Benjamin Lupu is here. Georgie's here. Who else? The regulars. Magnus is in the house. John Luca. Jerry's here. Thanks, guys. Thanks so much for turning out. We really appreciate you coming for the live. And as always, you are an intrinsic part of the show. Somebody's saying Josh is so tan. That's right. That's right. That's swim. That's a swimming pool tan. All right. We kind of added something into the show tonight, given market activity. I think we have to address it, and we will. But first, I want to tell you guys about tonight's sponsor, which is Rocket Money.
This is my favorite personal finance app. Every week I get a report. Here's how much money you spent last week. Sometimes a little higher, sometimes a little lower. Sometimes I pay my taxes, sometimes I don't. Just kidding. It's great. I see all of my subscriptions upcoming. I can even cancel. I say, why am I still paying for that? Boom, gone. Out of my life forever. Right inside the app. It's wonderful. It's fabulous. I can't live without it, and I think you shouldn't live without it either.
You guys, Rocket Money is a personal finance app that helps find and cancel unwanted subscriptions, monitors your spending, and helps lower your bills. Rocket Money has over 5 million users, has saved a total of $500 million in canceled subscriptions, saving members up to $740 a year when using all the app's features. Stop wasting money on things you don't use. Cancel unwanted subscriptions by going to rocketmoney.com/compound. All right, first things first. Let's put this first chart up, John. This is semiconductors having what looks like one of their worst all-time days. This is a 7.57% drubbing for the semiconductor stocks. And obviously, we know the culprit. NVIDIA is an extremely high weighting in this index. Some would say it's the general. And as a result, bad day for NVIDIA means bad day for semis. Let's take a look at this. What are we seeing here, Mike?
Oh, they're blaming Nick Majuli. I was about to say Nick's getting shrapnel, but actually he's getting credit for this. What do you think caused this?
I think the video we posted with Dan Ives, honestly, on Monday, it's only the first inning for NVIDIA. I think that might have, I don't know.
You think it was like the market gods with the Jordan, and I took that personally?
It's almost like we posted it's the ninth inning for NVIDIA.
Seriously.
What did Nick say? I didn't read his piece today.
Nick wrote a post that I didn't get to read either yet, but it's basically like, how could this be sustainable? Something trading at these valuations.
Yeah. Well, I think that's like a common sentiment. So there are people that have good reasons for how it could be sustainable, but that doesn't mean sustainable every day. So today, by the way, stock's still up 100% plus on the year. I think it's worth pointing out. And let's go back to that second chart real quick. So this chart starts on August 20th. No, the second one. This chart starts on August 26th of, hold on, what are we looking at? Yeah, this is just the last, I'm trying to count how many days. How many days is this?
6, 7, 8, 9, 30.
No, these aren't all individual days.
It's 6 days. It's 6 days.
Yeah, so it's a rough 6 days for NVIDIA. I think we should just mention what came out after the close. There was a subpoena of the company for documents related to an antitrust investigation. That train's never late. This is obviously a very dominant company, and I guess nobody should be surprised that they're being looked at. The U.S. Justice Department sent subpoenas to NVIDIA and other companies as it seeks evidence that the chip maker violated antitrust laws, an escalation of its investigation into the dominant provider of AI processors. So the question is NVIDIA doing things that are anti-competitive in how it sells its chips, how it markets its products to customers, and you could expect that to drag on 3 to 5 years.
We've got semis getting whacked, as you mentioned earlier. Micron is in a 43% drawdown. AMD down 35%. NVIDIA back in bear market territory, down 20%. S&P 500 down 2.2% from its highs. Not so bad.
So listen, man, when it rains, it pours. Today it rained. And I think when you look at the stocks that were down the most, many of them are stocks that have been up the most. At least over the last couple of years, and maybe even year to date.
This was for the most part all AI winners. So we mentioned NVIDIA and all the semis. Google down 4%. But there was a lot of green on the screen. Healthcare, great day. Telecom, the defensive names of Verizon's and AT&T's of the world. Consumer staples, ripping. Coca-Cola, Procter & Gamble, all the boring names, Pepsi. So it wasn't a total bloodbath, although NVIDIA, I forget who tweeted this, lost $270 billion worth of market cap. It's the worst decline ever for any stock in market cap terms of all time. So it was a good old-fashioned drubbing.
Yeah, what I'm seeing on my screen is a continuation of what's been happening sub rosa for a few weeks now.
Sub rosa? What, are you flexing on me? What does that mean?
Beneath the surface.
Okay.
It's Latin. So what I'm seeing, though, is like Pepsi was up almost 3% on the day. Mm-hmm. Monster Beverage is up. Ulta Beauty. You're seeing a lot of these stapley kind of situations quietly creeping up.
Ulta is definitely not stapley. No offense.
Makeup? You sure?
No, look at the stock chart.
It's a discresh?
Not even close.
Okay.
Coca-Cola looks like NVIDIA. We flagged this stock a few weeks ago.
Listen, Kraft Heinz was up 0.5%. So I'm just saying, like, there was some healthcare names that were up.
Campbell's Soup.
Yeah. I own a few that were green today. Invitation Homes, which is a REIT.
You own
That's
that?
obvious. Yeah. That's working because they're buying these REITs as the 10-year yield falls. I think the 10-year is now 3.68. Do I have that right? It's not in front of me.
No. 383.
What is it? 383. All right, but falling. And they're buying up the bond proxy equities and real estate and utilities. And some of the staples could certainly be considered to be in that group. So I had some green stuff, and it's just like when you look at it, it's like, oh yeah, I get that, I understand. Like Berkshire Hathaway rallied, which maybe we'll talk about later.
Every stock I own was down today, not to brag.
Well,
every single one.
Most stocks. Breadth was not good. Again, welcome to September. This is where we're at. All right, topic one tonight. I launched a book today, and Michael, thank you so much for your kind words on The Irrelevant Investor, your awesome blog. Do we have like an image of the book? Okay. All right, so guys, here's what we're going to do, because you guys are my day ones. We are going to do a giveaway. We're going to give away 6 signed books, and we're going to randomize this. 3 for current subscribers to the Compound Insider. There's a link below this video so that you can subscribe to the Compound Insider, which is free. It's just where we tell you stuff ahead of time and let you take a peek behind the curtain at all things Compound. And then 3 new subs. So if you're watching the show for the first time, within the first 24 hours, we will take all the brand new subs. We'll randomize it. We'll pick 3 people. I will personally sign a book to you. So if you're not yet subscribed to the Compound Insider, you go to thecompoundnews.com/subscribe. And if you're already subscribed, don't worry. You're already in the running. Michael, do you want to talk about how this is maybe the best book you've ever read?
Can I say a few words? I'd love to, yes. So I forgot the title, the namesake of the book. I forgot that was the title of one of your best posts ever. And this might jog your memory if you've been following along with Josh. He wrote about what happened during the pandemic when money was sent to everybody. Let me just read Josh. Let me quote you. Look at me while I quote you. Widespread prosperity, it turns out, is incompatible with the American dream. The only way our economy works is when there are winners and losers. If everyone's a winner, the whole thing fails. That's what we learned at the conclusion of our experiment. You aren't supposed to see that.
Yeah, so that was like this kind of epiphany that I had in 2022, I think, when we were fighting inflation and the jobs market was as tight as it's ever been. And the idea behind that particular chapter is just like, look, this is the problem. Everyone is good. Like, everybody has money. nobody has to do anything they don't want to do. And I hate saying it out loud.
Say it.
But that's the truth behind the way American-style capitalism works. There have to be people who are willing to work and do things that they wouldn't otherwise do if their bank accounts were flush. And
we need winners and losers, unfortunately.
You need people that have done really well already, continue to do well, and are spending. And then you need people who are on their way there. And they haven't. I thought you were giving me a round of applause.
Fucking nailed it.
And then you need people that are still on their way toward prosperity and willing to work for it. When everyone is prosperous all at once, it's very problematic for the economy, for companies, for business owners, for the stock market. So that's one example. But the idea behind the book is these are all the things that nobody really has a vested interest in sharing with you. And I wanted to do a book that just kind of took you there. And I said this on my blog today. I've done 4 books. I love everything that I've done, but like this is really the best thing from my own perspective. If somebody says, "What's one example of your writing?" This is the only thing that I would give them at this point.
I think so too. As I was reading this, to me, it really was a trip down memory lane because I read every single one of these blog posts, obviously, and a lot of them feel like yesterday. And there's like a weird time dilation going on reading some of these. It was odd. I felt a lot of feelings reading this.
Yeah, so the idea behind the book is let's take the most important or most interesting insights that I've had over the last 15 years as somebody who's been writing about the markets almost daily. What were the big ones? And then I update them and bring it all up to the present. And I've changed my mind about some stuff that I used to think. And some things that I wrote in the moment, we didn't really know what was going on. And then later we figured it out. And so that was a really fun exercise for me to go back and do all that.
So I would agree with you. This is the best book you've ever written. I read it very quickly. It's very incredibly readable. I would say that most of the topics that you wrote about, more is the same than has changed. Would you agree with that?
Yeah, because I think people don't change. And we talk about this a lot in an investing context. The same things that drove people 1,000 years ago drive people today. It's like most things boil down to people doing things because they get paid to do them. People reacting to scary things because fear is part of the permanent human condition. And then the greed aspect, which, it's like a pendulum. We all swing between fear and greed, some people more extreme than others. That stuff doesn't change. And so as a result, a lot of the stuff that I had written is universal. And it was fun to see that in hindsight.
Did you did Shari read this before you published it?
Yes.
Okay.
She was like, yeah, every page of this sounds like you. I don't even know what half this shit means, but it sounds like you.
You shared some personal stuff in here that I was. Oh,
you like the sex scenes? Well, I thought this was the one thing that I really haven't given my audience yet, so I wanted to.
They were waiting for it. No, listen. Truthfully, the book was fucking amazing. I kind of forgot how good of a writer you were because you just don't. We don't have time to write like you used to.
Now I'm blushing.
But it was so amazing. You are the only person in the world that could have taken their previous collections of writing and updated it and made it just like it was day one. So amazing.
Thank you so much, Michael. Guys, there's a link. I think there will be. Nicole will place a link if anybody wants to order the book. It's for sale everywhere. Amazon, Barnes & Noble. People are taking pictures of it in the airport. It's really exciting.
Like,
and thank you for all the support.
I thought I would kind of like thought through. Yeah, I read this already. I read every word. It was awesome. So everybody.
And by the way, I insisted with the editor that we keep it under 200 pages, and we did it.
Well, it hit the spot.
I think that's the new length of a book.
No, because
right?
you pick up the book, you're like, yeah, I'll read this. I have books that I want to read, but I'm not reading 400 pages.
I can't do it either. I can't start it because I know I'll never finish it.
Yeah. So, all right. Amazing, Josh. Really amazing. All right. Berkshire Hathaway, speaking of amazing, hit $1 trillion. So I don't know why we could only find data for this going back to 1987 or 88, but whatever. Since then, it's compounded at nearly 17% a year. And for comparison purposes, the S&P total return over the same time did a not so shabby 11%. But this 16.7% CAGR for Berkshire Hathaway, that, every time you have a long line on this, every up and down, it looks like a blip. But this includes a period, more than one period, but a period of massive underperformance. John, throw the dot-com bubble up. So from June 1998 through the bottom or the top, I guess, in March 2000, the S&P 500 did 31% over 18-month period. No, more than that. Whatever, 22-month period. And Berkshire Hathaway was down 41%, and there was articles written. He was on the cover. What's wrong, Warren? And that 16% includes that horrendous period of time.
And so I was there, and I didn't really know who Warren Buffett was, but I distinctly remember all the talk about how his style of investing is never going to work again in the internet age. And for like 2 years, it looked that way. That looked like because he was not going to buy internet stocks. And one of the formative things that I've ever read was Warren Buffett's own op-ed, which I think predated the top of the bubble by a year or two. But he wrote something for Fortune, and it was long. But I think it's one of the most foundational, important investor letters. And it was apropos of nothing. This wasn't his annual letter to shareholders. He just felt compelled to say, here's why I'm not buying tech. Like, I think enough people were breaking his balls that he was finally just like, okay, this is why I'm not running off to join the circus like the rest of you. And, reading it now, there's a lot in it that's just, it's outmoded and not true, but a lot of it's really true. They were saying that he was done. And then in the wake of the crash, everybody jumped back on the Warren Buffett bandwagon, and he was not just sitting in cash. He was making other investments that would pay off, years later.
By the way, he was 70 years old at the top of the tech bubble. He was 70.
Put up the first chart. Berkshire hits $1 trillion. So let's just talk about what this chart encompasses. It looks like it begins somewhere around the crash of 87, let's say. Within 2 years of this chart, Warren Buffett is testifying in front of Congress, effectively apologizing for the conduct of Salomon Brothers, which he had acquired. And Salomon Brothers was found to have been rigging the Treasury auction. The U.S. sells its bonds via auction, and Salomon, I think, was a primary dealer. I don't know all the details as well as I should, but that's the start of this chart, is Warren Buffett basically being interrogated by Congress. There are moments in this chart where he is one of the largest holder of financial assets, and we have the financial crisis. There's the airline blow up after COVID, and he is the largest shareholder of all 5 major airlines. So there's a lot of moments in here where it's like, the old man lost his touch. He turned 94 years old this past week, and he is the first non-tech company to hit $1 trillion in market cap. And as a matter of fact, I think the stock went up today. Did it? Yeah. Stock was up 0.25 percentage point today. So it's just this miraculous thing that continues, I think, to instruct all of us on the right way to invest, the right way to run a business.
So there had been a long period of time recently where Berkshire was underperforming over a 5, a 10, a 15-year period. Well, guess what? It's almost hard to believe, but he's outperformed over the last 1, 3, and 5. So over the last 3 years, Berkshire's up 66%. The S&P's up 27%. So kick the shit out of it over the last 3 years, over the last 5 years. And again, this is a time where nobody's beating the market. It's only mega cap tech. And now granted, he's a big beneficiary because of Apple, but still, over the last 5 years, the market's up 105%. He's up 135%. So the old man still got it. Credit to him. And congratulations on $1 trillion.
Charlie Munger died this winter, and I think this company added like $200 billion in market cap since.
He was an overhang.
Yeah, he was the problem. One of the big open questions about being an investor in Berkshire Hathaway is what happens when the inevitable, and God forbid, knock on wood, but Warren's probably not going to make it to 120, I'm just going to guess.
Yeah.
So I've been hearing this, though, since he was in his 70s, that this can't go on forever. I've been hearing this personally for almost 30 years. But that is a thing, and it'll be really, it'll be like a huge moment in the history of investing, if and when the worst should happen. And of course, what happens in the aftermath of that is a big question for shareholders because it's reality. I think they've spent the last couple of annual meetings going out of their way,
especially this one,
to really give investors a sense of what's going to happen after. And I think by pushing Greg up front and really like making it clear, like Greg is the guy and he's been schooled and he knows exactly what to do. Like all that stuff, I think is going to end up becoming really important.
I hope Warren lives to 130, but I don't think it's going to be a market event. Like the day he passes, I don't think they're selling. I don't think it's going to be down 7%. I just don't.
There's a school of thought that says it goes up because there are probably a lot of assets here that maybe should eventually be spun off to create shareholder value. But I don't believe in that school of thought because I don't think the people who are entrusted with running this business after Warren are like so anxious to undo all of his work. Like, I don't think it's going to be a situation where we start spinning things off and selling off assets.
Yeah.
I highly doubt it.
I agree. It'll be business as usual.
I think so. I think to the best of their ability, that's what will happen. Anyway, congratulations to shareholders of Berkshire Hathaway. Happy birthday, Warren. Okay, I want to talk about hedge funds since 2022. There was a piece by Michel Salarié working with some Goldman Sachs report that looked at the state of the industry. And it looks like about a third of hedge funds have not been able to get back to where they were in 2021, 2022, which seems like a lot of funds. It's about thousands of funds that are below their high watermark. And the reason why that's important is if they're below, they can't pay themselves performance fees. For the most part, I'm sure there were some exceptions. So let me just quote this, and then I want to hear what you think. All right, we know Tiger Global is the poster child. They lost 50% in 2022. To make investors whole and to be able to charge its full performance fees again, a hedge fund down of 50% needs to post gains of 100%. I think it's actually more than that. Goldman found that 1/3 of long-short equity funds have still not reached their high watermarks, although that number is down since the end of 2023 when 45% of them were still underwater. A prominent outlier is Dan Loeb, who was once called the hottest hand in investing. Third Point lost 21.8% in 2022 and gained only 4.1% last year. This year, it's up 10.9%, has a long way to go. So that's long short. Macro funds are the worst. Goldman says 45% of discretionary macro funds are below their high water marks by the end of the first half of this year. 47% of CTAs and systemic macro funds. CTAs are commodity trading advisors. So, from my perspective, sort of a form of macro. Are you surprised that macro category has the most funds that are still below their high watermark? I think I'm not surprised.
Not at all. No, it's the most chin scratching wizardry of all wizard bullshit. No offense. It's impossible. Discretionary macro is you're trying to predict 37 variables. I just don't believe it. Can't be done.
I jotted this down. I'm not surprised at all. I think there are amazing global macro managers, but I also think that category tends to attract the biggest bullshit artists and a lot of crackpot philosophers,
yes.
More so than any other category of hedge fund.
Yeah.
This idea that I'm going to predict weather, politics, war outcomes, economic developments all over the world, and I'm going to not only predict what's going to happen, I'm also going to tell you how it will affect securities, bonds, stocks, commodities, currencies. It seems like a Twitter joke, basically, at this point, that there are people sitting in a room attempting to do that.
So I do believe that some of the brightest people do macro, but also to give your money to that type of person, you have to believe in a lot of things. Like, you have to believe in almost sorcery. Like,
multi-strategy funds are doing the best comparably. Only 13% are below their high watermarks. On average, multi-strats need only a 4% return to hit their marks. So multi-strats are like what Izzy Englander runs at Millennium and basically the pods. So this is like the hottest type of hedge fund now, where it's one big fund, but all these little individual pods doing their own types of trades, different categories, different asset classes, and then funneling those returns up to the mothership. I think the investor community loves these because those funds have been able to hoover up all the top talent They have the most money. They can pay the
Millennium
most.
and Citadel.
Yeah. So, and look, they're coming out of 2022. Here we are 2 years later. 13% are below their high watermarks.
But that's nothing. That's
my point. That means 87% are doing better than where they were 2 years ago, which I think is proving the whole point of that category. What do you think?
Correct. Facts. I also think that you said earlier that 1/3 of long short equity funds have still not reached their high watermark. All right, but 2/3 have. And long short equity has been really difficult because generalizing, they short expensive, crappy stocks and they buy, there's relative value there. And that just hasn't worked for a long time.
Yeah, unless they're growth oriented and they've been riding these AI names, the internet names, it's obviously going to be an uphill battle because it's hard for every asset manager who's not overweight, the big winners. Long short equity is still the largest category, but the commentary in the piece is that nobody is adding money there.
Well, dude, nobody.
It's $759 billion invested in long short equity.
So long short equity is a true hedge, and who wants a hedge in a rip-roaring bull market?
Yeah, the second largest category of hedge fund is multi-strat. That's $704 billion. Let me put this chart up. So this is from May, so it's like 2 months out of date. Oof. But I'm sure directionally, this is hedge fund flows, the entire industry. This is from Pensions and Investments. The hedge fund industry ended the first quarter of 2024 with net outflows totaling $25.6 billion. That's the 22nd consecutive month investors have pulled cash from hedge funds. Long short equity managers led the quarter with $8 billion in net outflows. Macro, $7.4 billion in outflows. So I don't know if that's reversed by now. I doubt it.
Really rough.
Yeah, so you know where that money is going? It's going to another group of people who are making big promises that will probably disappoint. Yeah, it's going to private credit, private equity. You're seeing some traditional hedge funds now getting into more private equity, more private credit, because that's what their customers are telling them they want.
Yeah.
But the last thing I would say on this, these are brilliant people. They're hard workers.
The smartest.
They're the smartest people in the world. And I think the point is not that they suck at investing. I think the point is that the competition amongst all these brilliant people makes it so that returns are really inconsistent for any one fund. And people yank money fast these days. Like there's no cult of personalities left in
Mobison says when the degree of skill is so high, luck has a disproportionate impact on the outcome. It's like if there's 5 LeBrons playing 5 LeBrons. It's just the smartest and the best in the world all battling each other all day, every day. Now, of course, listen, there's a lot of retail that they're scalping off, and we'll talk about Jane Street and Citadel later. But for the most part, it's not because they're dumb. It's literally the opposite. All right, let's talk about Gungeon's article today. What was the headline? Americans are giddy or Americans are super bullish, whatever it was. The one chart that they put in terms of the household's allocation to stocks as a share of their financial assets, to me, this is more about what you should expect to see in a 15-year bull market, but also this is structural. And I don't think that this is necessarily, this is less reflective of the market and more reflective of the structural nature of the relentless bid that you talk about, Josh. But the auto enrollment in 401ks, the auto enrollment to target date funds, which are for younger investors anyway, predominantly stocks. So to me, there's less signal in that particular chart. Before I get off it, I wanted to get your thought on that.
Well, shout out to Gungeon, by the way. She was amazing on the Compound and Friends this week. I love the article. If we just go back to that chart, Michael, this is the stock market. Mm-hmm. So, yeah, of course, household allocations to stocks go up when stocks outpace every other place that people could put money, including cash, including houses, including small businesses. So, I guess small business and a house aren't financial assets. But, yes, of course, the allocation to stocks goes up when the stock market goes up. She was making the point that that the household stock allocations have inched up. It's about 42% of household financial assets, which is the most on record in data going back to 1952. Again, stocks are doing like 12 to 14% a year on average. Of course, the percentage of assets goes higher. Cash is not growing to that extent. It physically can't.
Right.
401k stuff is interesting that she talked about too. What'd you think about that?
How many millionaires there are? What was the number? Is it 497,000? Was that it?
Let me say funds. I don't have it right in front of me, but she's just making the point that everyone's bullish and retail is pretty bullish. I guess my only comment would be like, well, what do you expect? Right. Why wouldn't people be bullish? Look how much money they're making.
Right.
If they were bearish, wouldn't that be so much weirder?
That would be very weird. So, all right, zooming in.
I'm sorry. Let me answer your question. The number of 401k retirement accounts at Fidelity worth at least $1 million reached 497,000. That's up from 31% a year ago and obviously a record high. So net worths are higher. 401k balances are a big part of why. And you now have 500,000 people with $1 million or more in a 401. That's why people are bullish.
And they're contributing to these accounts every 2 weeks, and they're buying stocks. So, but zooming into to me that's structural, but zooming into the now, AAII bullish sentiment, which to me this is retail. It's elevated for sure. The
Not
average
today.
Yeah, the average is 38%. Right now we're at 51%, which it doesn't really get a whole lot higher than this. And as a corollary, I didn't include this. You saw bears disappear. The 2-week change in bears is like the largest 2-week decline in a couple of years. So again, it's people are responding to the market. What would you expect them to be? Why would they be bearish?
We saw some like extreme bearishness after the first week of August. Temporarily, it faded really quick. Then we had 2 consecutive weeks of peak bullishness. Wait till you see the readout after what we saw today.
Well, also, I think before today, through the first 8 months of the year, it was like the second best first 8 months over the last 30 years. So the fact that everybody's bullish, it doesn't take much to get people off sides and a sell-off, and who knows where it goes tomorrow or the next day. But yeah, people are bulled up, and they need a reminder that risk is real.
Here's what I want to tell the viewers and the listeners. All of this bullishness is contributing to a new casino-like atmosphere. We talked on the Compound and Friends this week about how leveraged and inverse ETFs have taken in over $100 billion year to date, which of course is a record. Two of the primary beneficiaries of all of this activity and gambling amongst retail, and we know it's a very high number, Citadel and Jane Street. So I would like to say to you, if you're placing a trade every hour, if you are constantly putting yourself into 0 day to expiration options, and I'm sure some of these trades are working, you are continuously feeding the machines that are Citadel and Jane Street. This is a Bloomberg piece that just came out. They have both released data on how much money they're making because they had to. They sold bonds to the public, and when you do that, you have to make some disclosures. And we don't really normally get data like this, but the primary beneficiaries of retail...
I'm surprised that they did that, by the way. Like, why wouldn't Ken Griffin just be like, yeah, I'll spot us a bill?
Well, because they're raising a lot of money from the public, and I guess he's at a point where it's like, we're one of the most profitable firms in the world.
Look how much money we're making.
All right. Citadel and Jane Street, 2 of the largest market-making firms in the U.S., are on track for record annual revenue. First half net trading revenue rose 81% to $4.9 billion.
81%.
Citadel. And rose 78% to $8.4 billion at Jane Street. So Jane Street in the first half of this year did $8.4 billion in trading revenue. Not trading activity, just their own revenue. And these guys are trading for a penny.
Yeah.
You understand? Okay. Jane Street sold a $1.4 billion high-yield bond deal earlier in the year, which is why they're reporting this publicly. Ken Griffin Citadel Securities generated $2.7 billion of earnings in the first half of this year. That's up from $1.1 billion a year earlier. It's almost a triple. Second quarter contributed $2.6 billion of net trading revenue and $1.4 billion of earnings. That's in a quarter. This is a market maker, okay? So all of your trades This is who's on the other side of those trades or facilitating those trades, and they are making money. In the first half, Jane Street's earnings, $6.1 billion. That's double the $3.1 billion of a year earlier. Okay? So this is really just an incredible period of time for people who are on the other side of not all retail, but a lot of retail. Jane Street makes most of its money in ETFs. I don't know if you knew that. I didn't really know that.
I didn't know that.
And Citadel is making money all over the place, payment for order flow, options market making, corporate bonds. But these are just two of the most wildly profitable businesses in the world.
So you said $6 billion in the first half?
For who?
For one of them? Doesn't matter. You said $6 billion. So just for context, over the last 12 months, Morgan Stanley has done $10.5 billion. So these companies are making as much as Morgan, and Goldman too. Goldman, $11 billion.
Yeah.
And over the last 12 months.
Oh no! If you're coming out of like an Ivy, and you've got like computer science degree or something, you're not going to Morgan Stanley. You're going to Jane Street. This is right, like the home of SBF. If you're like the hardcore quant, you're going to Citadel. Like that's the place that you want to be right now, and that's a testament to obviously how profitable these companies are and how successful they've been in the current retail environment. So I think it's just worth people understanding every time they place a trade. Like that's like kind of who you're trading with. in case you didn't know, you're not trading with me and Michael.
People just don't give a shit. It's like, all right, they'll whatever.
That's fine.
It's the rake. It's the rake.
All right. Japanese stocks. I'm not going to spend a ton of time on this, but this was a fantastic piece of research. One of the things that we've talked about on the show, Michael, is this idea that the success of America in the post-financial crisis period and in the post-COVID period is largely due to the breadth and depth of our capital markets. In Japan, the Tokyo Stock Exchange issued a directive asking all companies with price-to-book ratios below 1 times for a plan to get to 1 times book. So this is the exchange in Tokyo, told all the companies, you're trading at a discount to your book value. Figure out how you're going to change that and post it to our website. You ready for this? At the time of the announcement, 50% of the companies in the prime section were trading at a discount to a book, and 60% of companies in the standard section. So that's more than half. Once they started posting their plans, so the plans are like, we're going to do a stock buyback, we're going to raise our dividend, we're going to sell off non-core assets, we're going to do a merger. Put this chart up. This is what happened to the stock prices. This is incredible. This is activism at a country scale. This is literally the exchange in Tokyo conducting a mass shareholder activism campaign, and it fucking worked. This is, so for those listening, companies that did not make a disclosure of what they're going to do about it, they only had a 21% rise in their stock price. Companies that said they would consider doing something had a 28% rise. Companies that took a vague action, 31%. The companies that did a dividend are up 41%. The companies that said we'll buy back stock are up 46%. And the companies that did something related to cross-share holdings, which is like getting rid of things that they don't need or joint ventures or whatever, were up 56%. We have never seen anything like this on Earth. And the question becomes, does this become a model that other countries with severely depressed stock prices can follow? I have to believe that. By the way, this research comes from our friends at Verdad Capital, and it was really well done. I have to believe that countries in Europe could do this. Am I crazy?
When did you write American Gods, which was in your book? Do you remember what year that was?
I mean, in the last 5-6 years, maybe.
Okay. So Josh wrote a post about one of the reasons why our capitalist society works is because of the companies and the leaders that are running them. And so Japan did the same thing. Well, not the same thing. Japan is doing something to try and get their share prices up, and it's working. And credit to Verdad for doing that. That was like a hardcore machine learning.
It was a heavy lift.
Yeah, it was a real analysis. It wasn't just like on the terminal or anything like that. So is the Eurozone going to be able to follow suit? I have no idea how their political system works. It seems unlikely, but it seems like it makes sense, so it's not going to work.
I sent you a podcast this morning with Jimmy Pitaro from ESPN talking about a lot of things, but one of the things they got into was the NBA. And the interviewer asked him, are you worried that as the LeBrons and the Steph Currys and the Kevin Durants age out of the league, that they're being replaced by international players, and those international players may be less marketable to fans in the U.S., which, number one, I don't think is true. But whatever, let's take the premise at face value. I was thinking about international companies, and we've put a spotlight on like Mercado Libre, Meli, which is now the largest market cap in Latin America. We've talked about ASML and ARM Holdings and gigantic tech companies that are publicly traded in the United States but are based elsewhere, and there being opportunities. I think about like the coming dominance of international players in the NBA. I think about some of these companies in the same way. They take getting used to, but they're all reporting earnings to the standards of the New York Stock Exchange and the NASDAQ. We should be talking more about these companies because I really do think that countries around the world are paying attention to what's happened here, and they want that shit at home. They want massive job creators like Amazon in their own countries. So I think that we, like all of us, are going to get more excited about international companies in the future versus how we've been over the last 10 years.
We'll see.
What, that's like a bridge too far?
I mean, it seems like
they keep going up.
It seems like borders are closing, not getting wider, like not getting narrower. I don't know.
In some parts of the world.
And it's cultural. You can't just flip a switch and make stocks go up.
The guy in Argentina flipped a switch. I mean, you could look at the stock market for yourself. I think ARGT is the ticker for Argentina's ETF. He flipped a switch. He got into office and said, I'm going to basically cut every single government agency, and I'm going to cut taxes, and I'm going to cut regulations, and I'm going to fire all these bureaucrats. Stock market reacted like fucking immediately.
It's a wildebeest.
And it's a wildebeest. And I don't think that stock market is doing that in a vacuum. I think there's an attitude shift away from socialism that's underway in that country. And you're telling me if you live in Brazil or Venezuela or all of these places with all of the corruption scandals, et cetera, you're not looking at Argentina and saying, why not us?
Yeah.
So,
by the way, I learned the origin story of wildebeest. I never knew about that. Shout to Paul from your book.
Oh, yeah. No, that's me. That's me. They stole that from me. It's okay.
All right. So we're going to talk more about the single stock ETFs because Bloomberg, Josh mentioned we spoke about it last week with Gunjan and Paul, but Bloomberg had a great article. So U.S. listed single stock funds, which sounded like the dumbest fucking idea in the world, right? At the time, we were definitely laughing. Now has $13.4 billion after just 2 years. It's just 2 years. So this is really a face blower, whatever you want to call it.
This blew your face?
Right off my body. So the Europe listed, it's only $11 million, probably soon to be $75 billion. Granite Shares has a 3x long MicroStrategy. So MicroStrategy is up more than 100% this year. This thing is down 82%. Again, I repeat, the underlying unlevered is up more than 100% this year, and this piece of shit is down 82%. It's unbelievable.
Is this that guy Will Ryan that looks like?
I like Will.
Yeah, I like him too. He's Granite Shares, right?
Yeah, but this is just.
Doesn't he look like Hugh Grant? DL?
He's very handsome, but
he's dashing.
But here's the good news. If there is a silver lining here, I said last week that I think most people know what's up, and most people are using it properly, and they are, because they said in the article. Napkin math suggests that traders are following instructions, meaning don't buy and hold. For example, the $1.5 billion Direction Daily Tesla Bull fund has an average trading volume of nearly $303 million. So if you divide that by the average market cap of the fund, it produces a turnover rate of 28%. So meaning it takes only 3.5 days to completely flip its portfolio in terms of shareholders, which is good. That means that people are trading this. They're not buying and holding. That compares that same statistic for VOO, the Vanguard S&P 500 ETF. It's 185 days. So 3.5 days. John, we got a table for this. So single stock ETFs see the entirety of their shares flip in a few days. So again, NVDEL, which is one we talk about all the time, only less than 3 days for the entire thing to turn over. So for the most part, people are using these properly. Ben Johnson, however, said, and this is true, obviously, it's not everybody, inevitably, they're going to be unsuspecting victims of these products for whatever reason. There aren't adequate guardrails in place to prevent them from using without adequate knowledge of how to. Let me throw a proposal at you. What if the custodians sent a notification if somebody holds this for, say, 14 days, wherever the line is, and just sent out a notification, hey, these products are not meant to be bought and held? Why can't we do that?
I love that idea. When I was a branch manager at a retail brokerage, we had to get letters signed about 3X ETFs. It was TNA and TZA.
The TIZA.
The TIZA and the TINA, which JC was trading. But like the clients wanted to do these products, and the brokers obviously wanted to do them because you have to sell it in the same day. So you're charging a commission on the buy, commission on the sell, and if you hold it overnight, it's almost irresponsible. So needless to say, these became red hot at the old boiler room, and we used to have clients sign letters in advance stating that they are aware of the negative compounding of these ETFs. The thing is, it didn't fucking stop anybody.
I know.
Like honestly, I couldn't tell you definitively, but like I don't remember anyone not trading them after putting that letter in front of them. We were just almost like stamping a ticket. Like, all right, you're next on the ride.
But trading them is dumb, but it's fine. It's the whole thing. So I spoke with you about this. I said the tax is a volatility. I'm sorry, the volatility is a tax on these returns. So we made two charts to visualize this. So this is 1 year of decay visualized. The top line that grows from $1 to 99 cents, that's when you alternate between up 1%, down 1%, up 1%, down 1%. If you alternate between up 10%, down 10%, this thing falls 72%. And a lot of these products are doing that. MicroStrategy is volatile enough when you add leverage on it. And then if you got 3 years, Josh, up 10%, down 10%, you're down to 2 pennies. Like it just destroys you.
Maybe I'm an idiot, but why wouldn't somebody just buy MicroStrategy common stock using margin and get 2 times? Like if you want to be in it long term because you think it's like a way to leverage the upside of Bitcoin, and certainly it has been, just buy it on margin and make your margin calls periodically. Why would you own this? Unless you're going to trade intraday, I can't imagine what the reason is. So I like what you showed me, how high the turnover is, because maybe that does mean people know how to use these
for the most part.
Okay. What are people like buying and selling it 5 times in one day? Can there really be that many people who are engaging in this?
Well, I think a lot of it is like smart money. I really do think a lot of hedge funds are trading these things.
So they're arbing something out by trading this, and so
I think if they have a strong directional view overnight, they trade this. Balchunas tweeted some new style 2x ETFs launching today. These rebalance weekly and monthly instead of daily to try and limit the volatility drag.
Okay.
So we'll see if these take off.
This is just what the world needed.
Yeah, exactly.
I love your idea. I've never heard that idea before. It would not have been feasible in the days of snail mail. But I don't think it's asking a lot, so that when somebody opens up the app and they've been sitting in this thing for 10 days, it could be like, okay, you've now been in this thing for 10 days. Here's how they work. Please click that you have read this and understand it.
So the sports betting apps do that. If you're on it for too long, it says like, hey, you've been on this for 51 minutes or something like that.
Yeah, maybe chill out.
There's no reason why the custodians can't do something similar. All right, I want to highlight something that I thought was actually...
Dude, by the way, that's a great idea. Bartenders are trained, and not at Harvard, to tell a patron after 3 drinks, how about a glass of water?
Yeah.
After 6 drinks, I think it's time for you to go home.
Yeah.
Like that. Like this is like very, very big. Is it a law? Maybe it's not a law. Maybe it's just brokerage firms like growing up a little bit.
Custodians could implement this if they wanted to. I saw an ETF strategy that I actually think is kind of interesting. It's the opposite of this stuff. So Eric tweeted, new filing for the research affiliates deletions ETF, which will hold stocks recently deleted from big indexes. One that's about to get deleted, I think, from the Dow is Intel. This thing is down to 1/3 of 1%. It's the smallest weight in the Dow by far. I mean, I'm pretty sure that Intel's getting booted imminently. And Balchunas also tweeted, interesting timing on the RAFI thing, as Tom Sarafagas had this chart in a note today showing that deleted stocks, this is the S&P 500, deleted stocks in SPX tend to outperform. So
except when they go bankrupt. The ones that don't.
No, of course.
The ones that don't, there's a thing here.
But if you buy a basket of them, I like this idea. I'm for it. I think it's neat.
I like Rob Arnott. I think he's really creative and very clever, and I think we should have him on to talk about this thing.
Yeah, I like it. I
think it's clever.
Okay, I'm going to make the case, Josh. I'm following your footsteps. I'm going to recommend. First of all, the recommendation is to like maybe chill out a little bit, right? Like extremely bullish. We just got our first sell off. We're down 2%. Everybody relax, calm down. All right. Yeah. With that said, I made the case for IMAX on May 4th, and since then, John Chardon. It's done well. It's up 20%. S&P's up 6%.
Wow. Look at this.
Yeah, it's good.
I'm not following it. It looks like it's about to break out, though.
It is. So technically, it looks great. But I want to talk about the fundamentals real quick because I think there's like an actual story here. So we know that people's preferences for events and blockbuster stuff and really going after it changed dramatically from pre-COVID. So I think this chart is a great example of that. On the left-hand side, you've got the historical global box office, and it's in a steep drawdown from its 29 peak, and who knows if and when it surpasses that. IMAX, on the other hand, the premium experience, so the 2024, the dark blue, it's all projected, but 2023, like it's not far from the peak, and it's gonna demolish it. So why? It's because it's getting a stronger percentage of movies. It's less than 1% of total screens. I think it was like 70% of Dune tickets. Alien Romulus was 20% or something like that. So in 2018, it was 3% of the domestic market. I'm looking at the dark blue lines, 3.2%. Forget about 2020, COVID, everything was shut down. 2021, 4.4%, 4.8%, 4.4%. And hopefully they're looking at 5.2% in the first quarter of next year. This next chart shows the top 10 grossing IMAX titles. For the market share of the domestic weekend. Again, it's less than 1% of all screens. So if you're going to see, if you're seeing Fury, I don't know what I said Furiosa, whatever. If you're going to see a big action movie, you're going to IMAX. And then lastly, they are extremely shareholder friendly. They've purchased 19% of all the shares outstanding since 2020 at a favorable price. And lastly, Josh, you mentioned technically this thing had a reversal today as the market fell apart, but it's breaking out. The only concern is that there's been a lot of overhead resistance going back the past couple of years. Next chart, please. So this is on a weekly basis, so who knows if it gets turned around again. But I like the setup. It's my biggest position now, and that's the case.
I'm going to tell you, I think this is a great idea. I think the stock is going to work. I've been involved in it off and on for 18 years. And one of the things I would say about IMAX now that's different than ever before is it has become strategic to every studio with a $200 million movie. There was a huge debacle 2 summers ago when Oppenheimer came along and made it so that the new Mission Impossible couldn't stay in the IMAX theater. So they didn't make that mistake again, and no one's going to make that mistake in the future. Securing IMAX screens has become strategically necessary.
Mission critical.
You're going to see Marvel, I predict. You're going to see Marvel. You're going to see the new Superman film. You're going to see the highest grossing films break out how much they're making in IMAX, and you're going to see IMAX continue to benefit. They're also huge in China. They've opened tons of IMAXs all over the world. China is probably their second biggest market. So if a U.S. slate bombs over the course of a summer, it's not like they're not making money on something. So I think it's an interesting idea.
And they're re-releasing Interstellar. They're going to start doing that. Interstellar is going to do $100 million. Don't you think? Maybe that's high, but
I've always said the path back to large format screens, to getting people into the movies as though it's an event, is the nostalgia factor. I know it's hard to like get people to come out for something they've already seen.
Not really,
but
dude.
if
Terminator
marketed
2?
correctly.
Terminator 2?
Yeah.
In IMAX, I'm in.
Yeah, no, I agree. I think there's a few movies that you could bring back on 10th and 20th anniversaries every year that could supplement the period of time between new blockbusters.
We just have. I know this is not an IMAX movie, but the 30th anniversary of Pulp Fiction, like people will come out for that shit.
I agree. All right, you ready to play mystery chart, and then we'll get out of here?
Yep.
Okay, John, if you please.
Okay.
All right. The bottom chart in orange is a S&P sector, one of the 11.
Yep.
The top chart is a sub-sector of that sector. And the hint that I'm going to give you, and we're guessing the purple, okay?
Yeah, I think I know it. Go ahead.
And the hint that I'm going to give you is it's one of the top performing sectors of 2024 so far.
Okay. So the orange line is financials and the purple line is capital markets?
Very close. Not very close. You got half. Okay.
So I got the financials.
Yeah.
Is the top one insurance?
Bang. Second guess. Look at you. Reveal. Oh, shit.
Thank you.
Right. So this is actually an ETF. This is the IAK, which is the iShares U.S. Select Insurance ETF.
Not familiar with that one.
I was not terribly familiar with it either, but you want to hear something crazy? Berkshire Hathaway's not in it.
What? What are they in?
I asked Chart Kid Matt. I asked Chart Kid Matt to try to figure out like why isn't it in there. I think as of press time we don't have an answer. But I have some more charts from this. Let me show you really quickly. What's the next one? Okay. The purple is the iShares U.S. Insurance. This goes back 3 years, okay? It's up 66%. The XLF is up 26%. The S&P is up 30%. This has done double the stock market over the last 3 years. And I think a very big part of that is insurance companies have pricing power like almost no other industry. What are you going to do when the rates go up? You're going to not insure your house?
Right.
Your business?
Great inflation hedge, turns out.
It's an incredible inflation hedge. And if you were worried about inflation, gold wasn't the trade. This was the trade. Yeah. Now I'm showing you the two next to each other side by side. Did I have one more? What else did I? Oh, these are the holdings. It's market cap weighted. Progressive is 16%. Chubb is 12%. Travelers is 5%. AIG is 5%. Aflac is 4% and change. Most of these stocks, I'm showing you the change on a daily basis, but on a year-to-date basis, most of these stocks have done well. Let's put that performance chart up.
Yeah, these stocks are ripping.
Dude, look at this. Top 15 year-to-date returns within the Dow Jones Select Insurance Index. Oscar Health has doubled. Palomar, Mercury General, Progressive, Arch Capital, all up 50% or more. And then there's 10 others that are up 30% or more. It's really been an unbelievable place to be in addition to Berkshire Hathaway. Here are the top 5 holdings and how they've done this year. Wow. If you owned any of these, you're up double the stock market.
Nobody owns these names.
Nobody. I don't know anybody. I own Berkshire. I don't know anyone that owns those other 5.
Who's long Progressive? In the chat, raise your hand.
You know who's long that? Like value mutual fund managers. Yeah. And they absolutely smashed it.
Yeah.
So great job, second guess. Hey, everybody. Please remember, if you subscribe to the Compound Insider today, you are in the running for a signed copy.
Best book of the year.
You weren't supposed to see that. Michael Batnick says it's the best book of the year. Let me also say tomorrow is Wednesday, which means an all-new Animal Spirits with Michael and Ben. Thursday, we'll have Ask the Compound with Ben and Duncan. And then on Friday, the Compound and Friends returns with 2 special guests. Jill on Money on Saturday. Thanks so much for watching. Keep it locked on the Compound.